Welcome back to Investing Talk Podcast.
Today, we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
We are looking at a company that's been really defined by just extreme volatility and, at the same time, this tremendous promise, especially now.
Especially after that recent policy-driven surge.
Right. And our mission today is to figure out how a company with such, challenging financials is somehow attracting these huge upside price targets from analysts.
And to do that, you have to start at the top line.
Okay, so let's start there.
So if you look at the financials, they reported, over $821 million in revenue for 2025.
And that's a steady increase, right?
Yeah, it's a solid 4.1% increase year over year. And if you look at their trailing 12-month performance, revenue sitting a little higher, around $830 million.
And this isn't just a one-off good year.
Not at all. What's really crucial to note here is that this isn't just short-term noise. I mean, this top-line consistency is backed up by a 5-year compounded annual revenue growth that's actually over 10%. So they are very good at expanding the business and generating sales.
Okay, so generating sales is one thing, but converting that into actual profit, well, that's the challenge that really defines this stock.
That's the tension. That's what we have to resolve for you.
We have to look at their operational profitability because it paints a starkly negative picture. It's why the market often discounts them so heavily.
And that's the puzzle, isn't it? Because their gross margins are, believe it or not, surprisingly healthy at almost 29%.
Which means they're efficient at making their products.
Exactly. They're good at managing the direct costs. But it's the operating expense side where the numbers just collapse. Their pre-tax profit margins are sitting at a massive negative 139%.
Yeah.
And the EBITDA margins are also deep in the red at negative 160%. The core challenge for the company is crystal clear. They have the engine for revenue, but their operating costs are just way too high to yield any profit today.
And this is exactly why that recent earnings report wasn't just good. It was a fundamental signal of a potential pivot.
A huge signal.
I mean, analysts were bracing for another loss, right? They were expecting an EPS of negative 10 cents.
And instead, they delivered a surprise positive EPS of 20 cents.
A 300% surprise.
That is a 300% surprise beat. And in the investment world, a surprise of that magnitude is a massive indicator of improving execution.
It suggests management is finally getting a handle on things.
It does. It suggests that management is finally finding the right levers to pull on the operational side. Or maybe that the top-line growth is starting to come from higher margin areas. It doesn't instantly solve the long-term problem, but it completely changes the narrative around their ability to execute.
It certainly does. So when we connect that execution signal to the overall balance sheet, what do we see? I mean, this is a company with a history of high debt, but is that still the case?
Not nearly as much, no. Despite those historical concerns, the balance sheet today looks relatively robust. They're holding $1.54 billion in equity.
Okay.
And their current debt leverage ratio is only 0.17.
So that's quite manageable.
So says the debt they do carry is manageable if the business continues on this improving path. That execution signal we just talked about is absolutely critical to maintaining confidence in that balance sheet.
Okay, let's pivot to cash flow. This is where a lot of potential investors, they pump the brakes. Free cash flow, FCF, is still negative. It shows a $93 million outflow over the last 12 months. If I'm an investor and I see a red FCF number and negative EBITDA, why should I even bother looking deeper?
And that's the right question to ask. But this is where we need to look at the analyst models, because they are projecting a pretty significant inflection point. And they're basing this on the strategic decisions the company is making right now.
So what are they seeing?
Well, analysts are forecasting FCF to flip positive to $15 million as soon as 2026. And if you look even further out, they see it reaching $61 million by 2035.
Okay, but a transition from negative $93 million to positive $15 million in just 12 months. That's not minor. That's a massive operational feat.
It is. It's huge. And it's entirely based on margin expansion, driven by the very strategic pivot we need to unpack. The management team right now, their focus is growth, not dividends. They're reinvesting every single dollar of cash, hence the outflow, into these high-growth areas like specialized beverages and international expansion.
So the models are betting those investments start to pay off next year.
That's the bet.
Okay, let's unpack the valuation then, in light of this expected turnaround. The company's enterprise value is sitting around $1.4 billion. If we look at the core metric for a growth company, price to sales or PS, where do they stand?
So the PS ratio is currently trading somewhere between, let's say, 1.13x and 1.69x, depending on which numbers you use.
Okay.
What's fascinating here is just the sheer size of the discount the market is applying. Analysts widely consider a fair PS ratio for this type of growth and revenue base to be around 2.20x.
So we have a clear immediate valuation gap there. If the stock is trading at, say, 1.7x PS, but analysts think it should be 2.2x, that difference, that's the market's wall of skepticism.
Precisely. That gap suggests the company is materially undervalued if, and it's a big if, they manage to hit those projected FCF targets. The market is basically saying, we see your revenue, but we don't believe you can turn it into profit yet. And that PS metric is probably a cleaner indicator than, say, a discounted cash flow model, which, for a company like this, often shows overvaluation precisely because the analyst has to plug in those massive but still unproven future positive cash flows.
So we've got the financial hole they're digging out of and this incredible surprise beat that signaled better execution. For analysts to project a $150 price target, which is, that's truly a moonshot scenario, they must be betting heavily on the strategic changes the company is making. What is the operational miracle that's supposed to close this massive margin gap?
The miracle is the strategy itself. Diversification. The company is fundamentally changing its identity. They're explicitly moving beyond just being a pure-play cannabis producer.
Okay.
They're positioning themselves as a global consumer packaged goods, or CPG, leader. This means they're trying to smooth out all that regulatory and pricing volatility you see in the cannabis market by leveraging their distribution networks and their brand IP across Canada, the US, and Europe for a much wider range of products.
So they're basically running away from the deep discounting and oversupply issues that have been plaguing the Canadian cannabis market.
That's a great way to put it.
Yeah.
They're deliberately leveraging non-cannabis revenue streams. Think products like alcoholic beverages and hemp-derived THC drinks. This gives them much easier access to global markets where cannabis itself is still super regulated.
And that's crucial for generating consistent, non-volatile revenue.
Absolutely. But what are the tangible examples that show the CPG pivot is working in the cannabis space itself? It can't just be about drink.
Right. They have to fix the core business, too.
Of course. And within their cannabis portfolio, they're really focusing on high-margin premium products. A key driver there is their premium vapes, specifically the Radican brand, which has been rapidly gaining market share.
And they're innovating there.
Constantly. They recently debuted products like live resin liquid diamond vapes, featuring new strains like Space Age CK in key markets like Ontario and Alberta. This kind of innovation in high-growth premium categories is exactly what drives the margin expansion needed to flip that FCF. This focus on CPG branding and diversification, that's their competitive moat. It shields them from the pressures facing pure-play competitors who are just stuck competing on price.
Okay, now we have to talk about the fireworks. The stock recently had this massive technical action, soaring 65% in just 1 week. It hit intraday highs near 1240 from a close of around 840. A movement like that is completely disconnected from daily earnings. What on earth drove that explosive surge?
So that surge was primarily a sector-wide response. It was driven by the massive policy shift that's anticipated in the U.S. regarding marijuana rescheduling.
Right, the move from Schedule 1 to Schedule 3.
Exactly. The Department of Health and Human Services recommended moving marijuana from Schedule 1 to Schedule 3 under the Controlled Substances Act.
And for our listeners who might not follow the policy details, why is that such a game changer?
It's all about taxes and banking. Schedule 1 is for drugs with no accepted medical use, which imposes this devastating tax burden on cannabis companies through IRS Code 280E.
So they can't deduct normal business expenses.
Yeah, exactly. Rescheduling to Schedule 3, which is for drugs with medical use and lower potential for abuse, would potentially lift that 280E burden. That single action would transform negative margin U.S. operators into instantly profitable ones. And while this company is primarily Canadian, its U.S. expansion potential and just the rising tide lifting the whole sector is what drove that volume.
So the policy news drove the buying frenzy, creating the momentum. How did that volume impact the technical picture?
We saw an incredible high volume, something like 84 million shares traded during that week-long run. Technically, this rapid ascent has created the potential for what's called a golden cross.
That's when the short-term moving average crosses above the long-term one, right? A bullish signal.
A very bullish signal, yeah. And the stock is showing these classic bullish continuation patterns, consistently forming higher highs and higher lows.
But whenever you see a 65% jump in a week, you have to worry about the stock being overbought. Are we looking at a classic blow-off top here?
It's a fair concern, and we do need to unpack the indicators. Yes, the Relative Strength Index, or RSI, which is basically the stock's speed gauge, is likely flashing overbought right after a surge like that. However, if we look at the MACD, which tracks the strength and direction of the trend, it shows really strong bullish momentum. This wasn't just panic buying, it was supported by what technicians call hidden divergences that emerged during those massive weekly gains, suggesting the buying pressure is truly deep-seated.
Speaking of momentum, let's get back to that incredible analyst consensus target. ATB Capital recently upgraded their target pre-rally to 850, but the overall consensus is pointing toward a massive long-term target of $150. I mean, that suggests analysts are predicting a multi-fold return here.
That $150 target is definitely the moonshot, and it only becomes achievable if that policy change goes through and the CPG diversification fully matures. But we can't analyze this without addressing the pretty significant bear case.
Agreed. Despite the momentum, the two primary risks are profitability execution and policy timing. Let's start with the one that gives every investor pause: profitability.
Right. Risk number one is the execution risk. It's inherent in those deep negative margins. While we talked about that one EPS beat, the company still reported a massive negative $2.15 billion trailing 12-month net loss.
Which is a staggering number.
It is. And if management slips or if that CPG pivot doesn't deliver the projected margin expansion, an execution slip could be catastrophically costly, especially given their history.
So how do we balance that $2.15 billion loss against the investment thesis? Doesn't that single number just dwarf everything else?
It's scary, but this is why we keep coming back to the valuation. That massive loss might already be priced in, which is why we saw that low PS ratio of 1.7x we talked about. The market knows they're losing money today. The bet is on whether they can stop. And furthermore, that current debt leverage ratio of 0.17 suggests the existing debt is manageable if that FCF inflection actually happens in 2026. The danger isn't the current losses, it's the failure to transition away from them.
Okay, risk number two: volatility and timing. This stock is not for the faint of heart. It's high beta, sitting around 2.13. Can you explain that beta figure for the listener?
Certainly. Beta just measures a stock's volatility relative to the overall market. A beta of 1 means it moves exactly with the market. A beta of 2.13 means this stock tends to move 2.13% for every 1% move in the broader market.
It's rocket fuel.
It is rocket fuel, and that cuts both ways. The other side of that risk is policy delay. Any uncertainty, any slowing down, or any unexpected political resistance in the U.S. rescheduling timeline, which is currently high probability but also highly speculative, could trigger a massive, sharp downward correction. It could wipe out those 65% gains very quickly.
So looking forward, volatility aside, what should investors be watching on the catalyst calendar?
The calendar is pretty packed for early next year. First, the next major earnings report is scheduled for January 9th, 2026. The consensus EPS is already set low, around negative 50 cents.
So the bar is low.
The bar is very low. And given the Q4 surprise, a beat is certainly possible, especially driven by the momentum in their vape and beverage segments.
And product launches, I assume. The success of the CPG pivot is tied to that.
Exactly. The National Ridican vape rollout is slated for early 2026. That's a major test of their ability to translate regional excitement into national market share and, critically, higher margins. You should also watch the performance of their beverage diversification over the holiday season. Macro-wise, the actual progress of U.S. cannabis rescheduling needs to be monitored very closely.
So what does this all mean for you, the listener? We have this confluence of factors: high volatility, a strong defensive CPG-focused moat, a massive Q4 EPS surprise signaling execution is improving, and these major sector-wide policy tailwinds.
The investment thesis fundamentally hinges on resolving that conflict between the messy current financials and the projected future potential. The belief is that the 65% rally, while huge, still undervalues the company's diversified CPG business and its robust top-line revenue. At 1.7x PS, it looks favorable against that 2.2x fair value target from analysts. Strategic pivot towards premium products and beverages, combined with the policy catalyst, it positions them perfectly for significant margin expansion.
So this stock is either a swing trade or a multi-year hold, right? You're either capitalizing on the momentum leading into the January 2026 earnings, Or you're in it for the long haul, anticipating the full realization of the U.S. rescheduling benefits that could make that $150 target viable.
The key takeaway for you is watching whether that CKG strategy can finally translate those impressive top-line numbers into positive free cash flow over the next year. That transition, that FCF inflection point in 2026, is the single most important metric. If they can prove they can turn revenue into cash, the market will re-rate the stock, closing that PS gap and validating that multifold upside.
That wraps up our analysis on stock. But here's a final thought for you to chew on. If the stock is moving on policy tailwinds today, how much higher will it soar if the policy doesn't pass, but they manage to hit that positive 15 million FCF projection anyway? Is execution or legislation the real catalyst here?
Something to consider as you watch the calendar unfold.
Make sure you subscribe to the podcast so you don't miss our next look into the markets.